But I think the most important thing to note here is that election years are good for the market. Um, Generally, we are seeing positive double-digit returns during election years.
Hello, Apriem family, and welcome to another episode of Apriem Financial Cents. In today's episode, I sit down with Jose Rendon, who's one of our financial analysts here at Apriem Advisors. We talk about the markets, what happened first quarter, what's kind of expected to happen second quarter, but more importantly, we talk about a presidential election and how historically the markets have been affected during those years. So I really hope you enjoy the content today. Hope you've been enjoying the show. If you do, I would encourage you to please subscribe to the channel and hit a like, and let's get into it.
So bring us up to speed. I mean, kind of let's talk a little bit about, we're already well underway in second quarter, right? But you want to talk a little bit about, recap. What happened, January through March of this year, and kind of what are we seeing moving forward after that?
Yeah, Q1 really was quite surprising. The market has really moved up, and that there's lots to say about what has happened. In particular, the most popular trades, AI. You can't get away from that. But I don't really think that's what set the tone for Q1. It really was the Fed and what the Fed was expecting to do.
Where were the rate cuts? The rate cuts never came, right? We thought it was going to happen in like March.
Exactly. And, I think investors maybe got a little ahead of themselves. And we've covered this before that going into the year, and investors expected about 7 rate cuts this year, which I think was a little too
aggressive.
A little too aggressive.
A little too dovish.
Yeah. And I think in part that is what moved the market up. But the most impressive part is we're in the second quarter now, moving into the halfway point, and I think market participants have really scaled back their expectations for rate cuts this year.
Right.
We were about 7 in the beginning of the year. Things have moved in line with what the Fed is saying, 3. Now we're seeing some market participants may expect 0 rate cuts. That wasn't there in the beginning of the year. But I think the most impressive part is that even though investors have recalibrated those expectations, the market still stayed up.
Yeah. Right.
Mm-hmm.
It's held strong. And so, correct me if I'm wrong. I feel like, in the beginning it was, we think that rate cuts are going to happen in March. And then it got kind of like pushed back, and it was something like, maybe in June, maybe July. The most recent that I heard was maybe something like September. Are we still hearing September timeframe, or does it seem like it really is getting pushed into next year? I guess the majority of analysts' expectations that you're seeing out there.
Yeah, as you mentioned, rate cuts were mostly slated for June. So we have a few Fed meetings slated for the rest of the year. But as of now, market participants expect, and it doesn't look like there's a full expectation, maybe like a half of a rate cut, which you can do. It has 25 bips is what they're going for. And we're really seeing that priced in for September. So there's quite a big jump there in terms of the time frame of seeing 7, then 3, and now those 3 have been pushed back to the later quarter of this year.
Right. And just for clarification, when we say 25 bips, right, that would be 0.25%.
Yeah,
right?
Quarter of a percent.
Quarter of a percent. Okay.
Mm-hmm.
Okay, and then on top of this, I know a lot of the reason why this is all getting pushed back is because, the economic news has been really strong, right? And inflation's been continued to be stickier, and kind of remaining, more elevated than expectations. But we could get news that comes out along the way that all of a sudden we see a dip in inflation. If that were to occur, would we expect to see this kind of narrative shift again, and change back? Or is it pretty solid and fixed that we're going to, those rate cuts are really getting, held till really towards the end of the year, or maybe pushing it next year?
Yeah. As far as the Fed is concerned, I think that they are really cautious with setting any specific deadline for when they're trying to do things. We've repeatedly heard the comment that they are data dependent. And I think what they're concerned about is inflation reaccelerating.
Right.
But to your point, if inflation didn't reaccelerate and things played out perfectly, I think that they would start to mention confirmation that they're seeing things settle down. And really, I think it's upside risk to inflation really reaccelerating.
Right.
And I think if data comes in, and again, this is data that is usually lagging by a month or so.
Right.
They'll have strong basis for hitting some rate cuts, but I think it's still going to be a gradual move down. I don't think it's going to be sudden. I don't think we're going to see 7 rate cuts priced in, again for 1 month,
And so I know, obviously, I think from like investor standpoint, there's a lot of excitement about rate cuts happening, right? But personally, I felt a little nervous about, hey, 7 rate cuts, that's really, really aggressive. I think, from that standpoint, could you paint a picture of what would the economy actually have to look like to have that many rate cuts actually, be realistic? I mean, what do we see happening in the economy in the case that we're getting 7 rate cuts? I mean, that's a really rapid decrease in 1 year. Is that a good economy for that to be happening, or is that a bad economy? Because personally, I feel like I'm in the camp that slow and steady decreases is probably better for all of us. Maybe the stock market's not going to soar on slow and steady, but overall, that's probably a better picture. Am I thinking this properly?
Yeah, I think drastic moves would happen because there are some drastic things happening in the economy. The biggest thing that I can point to is unemployment.
Right.
Really, we would have to see a very large jump in unemployment in order for the Fed to say, hey, like this has been getting out of control.
Right.
But putting it past that, I think the economy is balancing, but it's in a good place.
Right.
GDP's in a good place. Corporate earnings are reaccelerating. So unless the economy came to a full stop or there's further like global conflicts that could really impact the U.S. economy, I don't really see potential for that, at least going into the end of this year.
What kind of obstacles are you seeing as we move into the second quarter here?
Going into the later part of the year, I think what is in investors' minds is the presidential election. There's lots to say about it, but I think the one thing that we will definitely see is at least some bit of volatility in the market.
Now, that's pretty common. It's pretty common to see
common.
Some volatility, in the market during a year when we've got a presidential election on the calendar.
Yeah, and history has shown that typically in election years, we tend to see some volatility in the first half of the year until markets start to pick up. In non-election years, it's been a slow trend up. So we actually have a chart up, which shows in the pink line during presidential election years, we see some bit of choppiness in that first half versus the top line, the black line, which shows non-election years, where things are just steady and growing. So clearly, investors during election years tend to be split between what's going to happen. But at the end of the day, it looks like the market does recover at the last half of the year. But I think the most important thing to note here is that election years are good for the market. Generally, we are seeing positive double-digit returns during election years.
Okay. And do you think that a lot of that is because of in the early half of the year, maybe there's less of a picture around where we're going to be, and then as we get closer to the later half of the year, it seems to be that that picture is a little bit more clear. And so I think the stock market likes to know what's happening, right? And so do you think that's typically why we see this kind of a pattern or shift? I mean, it looks like this information is going all the way back to what is that, 1896. So it's not like this is very, just recent. We're talking historically. You can see this average is slump in the beginning of the year, then start to accelerate towards the end. Any real reasoning behind why that happens that way?
No, I think you hit the nail on the head. I think investors are concerned about where major policies may go. I think taxes is probably one of the big things where, the two parties are a bit different on their stances there. And I think like you said, once there is a little more certainty, which the market likes to see, then things start to move up. I don't think there is a difference in which candidate or which party they're part of. I think it is really just like figuring out where things might end up going, getting that little bit of certainty.
Because regardless of which side we end up on, it's that certainty about what kind of policies to expect. And so the markets can then just begin to adjust to whatever party that's going to be, right? And start to maybe take a stance in that way.
No, yeah, you're exactly right.
Okay. And so what about this other chart that we're seeing here, where it's kind of talking about, average returns? I know you kind of mentioned it in double-digit returns, but you want to kind of just talk through this chart here real quick with us?
Yeah, so the chart here shows returns from 1928 to 2016 for the S&P 500. And it shows between the two party lines, Republican and Democrat, that during presidential election years, the market generated positive returns. But the most important part is that bottom line. All election years accumulated together, the average return was double digits, 11%, a little over 11%.
Yeah.
So I think pairing that back to our previous conversation about seeing volatility in the market, regardless of the market being choppy, I think it'll be choppy, but it will still trend up. It tends to trend up.
Right. Historically, on average, it tends to trend up towards the end of the year, the latter half of an election year, like we're seeing. It's kind of interesting because markets started off real roaring strong, right? It's kind of tapered off a little bit most recently, and so it kind of makes you wonder. We're in that April, moving into May timeframe there, in which you can see on the pink line of the other chart. That's when it starts to slump through summertime and then bank back up towards the end. Now, granted, I know this is all, historical information, right? So it's not necessarily an indication of what's actually going to happen throughout the course of this year, but I think it gives us a pretty good understanding of what we should be expecting moving forward. How about as far as corporate earnings go? Anything there that's of note or things that we should be paying attention to?
Yeah. The biggest thing, and I think where everyone is really paying attention to is the Mag 7, and earnings for those top stocks have been superb, to say the least.
Right.
And this starts to bring light to the remainder of the S&P 500, the S&P 493,
right?
Where earnings really weren't accelerating as high as for those Mag 7 names.
Right. And so just to clarify for everyone's listening, in case they don't know, the Mag 7 or Magnificent 7, these are essentially the top 7 performing names out of the 500 companies that are in the S&P 500 index.
Exactly.
Right? Okay.
Yeah.
All right. Continue.
Yeah, so the S&P 493 had seen some very slow growth here.
Right.
And one of the things that we also like to look at is what the economy is doing. So the economy is slated to continue to grow, albeit at a slower pace, but it will continue to grow. And off of that, it's just going to translate into growing corporate earnings. So really, I think the expectation here is that the performance of the market is going to be a little broader. It isn't going to be just accelerated or concentrated in those 7 names, and it'll start to move on down to the rest of the S&P 493.
So that almost kind of goes more on the opportunity side of things, right?
Exactly.
You've got opportunity that exists in all these other companies that have been moving a bit slower, just due to interest rate hikes and all those other economic conditions that we would normally be looking at. But AI and everything's been happening with the Mag 7 has kind of almost overshadowed what's been happening with the broad economy. Am I hitting that right?
Yeah.
I am? Okay.
You're dead on.